Hello and welcome to Fen Business. Today we are in conversation with a very special guest. His name is Sunil Sharma and he heads the Actuary department of Kotak Life Insurance. Sunil, welcome on the show.
Thank you.
So my first question to you, or rather I would like to take your perspective on how do you actually craft the policy? How do you actually analyze the risk? What are the parameters that you follow?
See, I think when you want to price a product or design a product, you have to keep the customer's need at the heart of it. So, when does the customer need, what are the contingencies in the life of a customer? So say for example, what are the potential needs of that customer? Someone actually wants to accumulate the money for their children, or they want to protect the lifestyle of their family members, or they want to protect their own lifestyle. And based on that, you actually have various different types of products. So far the risk is concerned, I think insurance companies in the business of taking the risk. Typically, life insurance companies do have enterprise risk management policy in their companies, and they look at the entire risk of the entire organization in a very systematical manner. So for example, if you look at, they look at various risks in their bucket. They look at the whole demographic risks, they look at their mortality, morbidity, persistency, expense risks that they have. Apart from that, there are also financial risks, which are more of economic risk in nature, like interest rate risk, equity risk, you got the liquidity risk. Absolutely. You also got credit default risks. And all these risks are looked at separately, and the companies look at what can we do with those risks, because those risks come as a part of the business. And therefore, the company will have to look at in terms of can we reduce those risks, can we avoid those risks, and if you cannot avoid those risks, can you hedge those risks, and if you cannot hedge, can you transfer those risks? Say for example, some of the risk can be transferred to the reinsurance companies. And as a result, there are certain risks with insurance company obviously we have to retain, residual risks. And therefore, the company try and calculate the economic capital, how much they have to hold to meet those risks if they actually gets realized. And therefore, it's very important to manage these risks, because life insurance companies has got 30-40 years contracts. They got policies, the premiums are guaranteed, the benefits are guaranteed. And so it's extremely critical for insurance companies to manage those risks.
So, the instant question that comes to my mind is, how do you actually control your underwriting losses? Because that is one area, if you go right there, perhaps your risk will go down. So how do you actually maintain that underwriting under your control? If I'm not wrong, when I was going through reports, I understood that Kotak has actually succeeded and controlled their underwriting losses compared to many other companies in the life insurance sector. How could you do that?
So I think if you look at in a life insurance company, the two critical risks that you see for which are linked to the behavior of the customers. One is, that the customers, they know much more about themselves. So everybody goes through annual health checkups. And if they're diagnosed with some problem, they know much more. And therefore, the behavior of the customer usually is to not to share that with the underwriters. And that is we call as anti-selection risk. The customer is anti-selecting against the insurance companies. There is also a moral hazard risk, wherein the behavior of the policyholder changes after taking the policy. And one example I give is, let's say for example, someone took a burglary insurance. And the person's behavior changes. Say for example, after coming on the way to office, and in the car you realize, I don't know whether actually I closed my door or not. I said, oh, forget it. I got the burglary insurance, and that'll be taken care of. Let me just go to office. So that's kind of moral hazard risk. We in Kotak Life are very concerned about these two risks, and we try and manage those risks by having our risk management policy, the selection of the lives, the underwriting policies that we have, and also setting the non-medical limits in a way so that we less likely to get anti-selected by the people. So that's and it's working very well.
But you look at insurance sector, specifically life insurance sector has been, what you can say, divided between two parts. One is term insurance and second is endowment policy. Now term insurance is very simple, but when you look at the endowment policy, there are what you can say innumerable products which each and every company is offering. So when every person is different and he wants something different, how difficult it is for you to craft a policy which will be what I can say famous for large number of people?
Interesting question. See, I think if you look at any of the products, just forget about insurance, any of the products, I think simplicity is the key. The customer really has to understand the product, and they want to really, they buy something which meet their needs, and it's simple to understand. Term assurance is a no-brainer. I think everybody, there's nobody in the world who does not need term assurance, and it's the most simplified product in its form.
Absolutely.
You pay the premium. If something happens to you during the term, the death benefit is paid. So far, the endowment product goes, I think it's extremely important to align the benefit from the policy in line with the needs of the customer.
Absolutely.
So say for example, someone needs money after every 5 years, you have to make sure that the product sold to this customer is a money back policy. If someone needs money after the end of the term, then you have to actually give them endowment policy, in which if something happens during the term, there is a coverage, and at the maturity, they're able to meet the cash flows from the policy are able to meet their liabilities at that point in time. And I think one other thing that we keep in mind is that there are products, each customer has a different need. So say for example, there are people who are financially sophisticated and they understand the financial market very well, and they can take the decision in terms of switching the funds.
Right.
So the unit link product is more appropriate for them compared with traditional products. People who are less financially sophisticated products, they might like to go with endowment products or with profit and guaranteed products.
All the financial sectors, specifically those who are taking the money from the people, whether you are a bank taking a deposit from the people or you are actually insurance company taking a premium for the people, are highly regulated. Obviously, life insurance sector is also the one. IRD has many tick boxes when you actually craft the policies. How do you actually maintain the balance between what the norms that IRD has prescribed and the innovation which 24 other companies are also coming? How do you actually maintain the balance there?
Very interesting question. I think so it's really so if you look at regulator is right in its place. They want to make sure that the interest of the policyholders are protected. And therefore, they try and make the regulations in a way so that the policyholders' interests are taken care of. But obviously, this puts some constraints in some of the innovation. We try and first look at the needs of the customer and say, well, the regulation don't exist.
Okay.
And then after that, you craft the product and then put in the regulatory constant in that and try and modify the structure so that you are close to the need of the customer. And at the same time, you are compliant with the regulations. So that helps us to be a little more innovative within the constants obviously imposed in the product regulations.
If you look at the insurance sector now, LIC was the only company, but in last 15 years, we have many companies now. In life insurance also, it's almost 25, 26 insurance companies offering products in the last 15 years. But the penetration is still very less. What government of India did 2-3 years back, they came with this life insurance policy called Pradhan Mantri Jivan Jyoti Yojana, and it actually created a difference. How actually you are going to those rural markets, how actually you are helping insurance industry to grow, which perhaps didn't happen in last 15 years.
I think it was a wonderful initiative by the government to introduce. It was a good beginning of the social security in India. We started with Prime Minister Jivan Bima Jyoti Yojana. It increased the awareness of the insurance across the length and breadth of this country significantly. We at Kotak Life, we are very, very interested in growing and penetrating into the rural areas of our country. And we do a lot coverage in terms of micro insurance.
Right.
So, you got micro financial institutions who do offer small loans to, all these people with 10,000 rupees loan, 20,000 rupees loan. We do provide protections to all these people. And we got, over 2 to 3 crores of people in our portfolio from the micro insurance coverage. Also, we've recently launched a product which is point of sale product, which is one of the unique product. The IRD actually came with some sort of guidelines on how could you simplify the products. And so we recently launched a point of sale product in which the policy can be issued within 48 hours. So that will help us to increase the penetration and faster issuance of the contract, low ticket size, simplified underwriting, quick issuance.
So are you underwriting different policies for those kind of people specifically living in hinterland?
So the people who are in rural areas, there's no underwriting. If you look at it, it comes under the group insurance. So everybody who takes loan from micro insurance are being insured under the same contract for their loan, whatever loan that they've been taking. So that if someone happens to the person in the family who's taking the loan is repaid by the insurance procedure.
Why there is a shortage of actuaries in the industry and how actually you're dealing with it? And you know, there is a trend if you look at actuaries in global, in basically the different parts of the world, the actuaries are also writing risk for the banks and different pensions and you know other schemes, but here specifically actuaries are working specifically for the insurance sector. What kind of trend is there? How is the reality? If you could explain the specific actuary profession in India.
I think if you look at up to 2000, there was no demand for actuaries because LIC and GIC were the only companies. After the privatization, the demand for actuaries has gone up significantly because all the insurance companies will have to have their actuarial teams. And so there was a demand gap delta from 2000 till, say for example, a few years back. But now, if you look at as on today, when I'm sitting here talking to you, we've got about 375 qualified actuaries of the Institute of Actuaries of India. And what I want to share with you is that actuaries do not only work for insurance companies. If you look at markets overseas in UK and USA, they work in any of the financial services. They work in the area of investments, they work in the area of risk management, they work in the area of regulators. They also, a large number of actuaries also work for government in the social security area. You know, how to make sure that your social security is optimal, most effective for the people. They also get involved with the planning, the government planning, in terms of how do we make sure that the government plans in a way that the resources can be optimally allocated to social security goals of the government. So I think given the fact that now there is a good number of actuaries who qualified in India, we expect actuaries working in almost everywhere wherever the long-term liabilities are there. It's just not financial services. Actually, any wherever there are risks, actuaries are best suited actually to manage those risks.
Great. So good learning for me and my viewers. Thank you so much, Sunil, for sharing those insights. Thank you so much.